Something unusual is happening in the precious metals market right now, and I want to make sure you understand exactly what's going on before this moment passes. Gold is sitting at $4,570 today, and yes, that number is lower than where it was recently. Silver is also pulling back. On the surface, that sounds like bad news. But here's the thing. When you zoom out and look at what analysts are forecasting by the end of this year, the picture looks very different. We're talking about an 80-plus price target for silver. So this raises a genuinely important question. Is today's dip a warning sign, or is it actually the moment that long-term investors have been quietly waiting for? That's exactly what we're going to talk about today. My name is John Smith. Welcome back to the channel. If you're new here, this is a place where we break down what's happening in markets and help you think through what it means for your money. Without the noise, without the panic, and without anyone trying to sell you something. So, let's get into it. Let's start with the basics, because before we can understand today's price action, we need to understand why gold and silver prices move the way they do in the first place. These aren't just shiny metals sitting in a vault somewhere. They're assets that have served as a store of value for literally thousands of years, and in modern markets, their prices respond to a whole mix of forces: interest rates, inflation expectations, the strength of the U.S. dollar, global uncertainty, and investor sentiment. All of those things are constantly in motion, and right now, several of them are moving at the same time. Here's what this means for the current moment. When the dollar strengthens even slightly, gold and silver prices tend to dip in dollar terms. When investors feel more comfortable taking risk, maybe because stocks are doing well or economic data comes in positive, some money rotates out of safe haven assets like gold. And when interest rates stay elevated or there's talk of them staying higher for longer, gold becomes less attractive relative to interest-bearing assets. These aren't conspiracies or manipulation. They're just the mechanics of how these markets work. And right now, a combination of these factors is putting some short-term pressure on prices. So gold is at $4,570 today. Now, I want you to hold that number in your mind for a second, because context is everything here. A year ago, gold wasn't anywhere near this level. The incredible run that gold has had over the past 12 to 18 months has been one of the biggest stories in the commodities world. Central banks around the world have been buying gold at historic rates. Inflation, while moderating, hasn't fully gone away. Geopolitical uncertainty remains elevated. All of those structural forces that pushed gold higher, they haven't disappeared. What we're seeing today is more of a pause than a reversal. That distinction matters enormously if you're trying to make smart decisions. Let's break this down a bit more. There's a concept in markets called a strategic dip. It sounds like financial jargon, but the idea is actually pretty simple. A strategic dip is when an asset that is in a longer-term uptrend experiences a short-term pullback, a moment where the price drops temporarily before continuing its broader move. These dips can feel uncomfortable when you're in the middle of them. Your screen shows red. The headlines start to say things like "gold falls" or "metals sell off." And suddenly, even people who believed in the long-term story start to wonder whether they should wait or whether something has fundamentally changed. Here's the important question to ask yourself in those moments. Has anything fundamentally changed, or is the price just taking a breather? That's the real analysis. Not is gold down today, but why is gold down today? And does that reason change the long-term picture? If the answer is that a short-term technical factor, like dollar strength, profit-taking, or a shift in short-term sentiment, is driving the dip, then the long-term case might still be completely intact. If the answer is that something structural has changed, like inflation suddenly collapsing, or central banks reversing their gold buying, or the geopolitical situation dramatically improving, then maybe the story has changed. Right now, the evidence is pointing more toward the former than the latter. Now, let's talk about silver, because silver is where the story gets really interesting. Silver is a fascinating asset because it's not just a monetary metal. It has enormous industrial demand that gold simply doesn't have to the same degree. We're talking about solar panels, electric vehicles, electronics, medical equipment. The green energy transition that's been building for years requires silver in massive quantities, and demand from that side of the equation has been consistently strong even as broader economic conditions have been choppy. The 80-plus price target that analysts are putting on silver for the end of this year, that's not a casual guess. It's based on a combination of factors: tight physical supply, rising industrial demand, the gold-to-silver ratio that many analysts believe has room to compress, and the monetary demand that tends to follow gold higher with a lag. Silver often moves after gold, and when it moves, it tends to move faster and with greater magnitude. That's both a risk and an opportunity, depending on where you're sitting. Think about it this way. If gold is currently at $4,570 and silver is trading at a much lower price, the ratio between them, what you call the gold-to-silver ratio, is quite wide. Historically, when that ratio compresses back toward more normal historical levels, silver outperforms gold significantly. A lot of analysts who are bullish on precious metals right now believe that silver is the more asymmetric opportunity, meaning it has potentially more upside relative to its current price. That's why the $80 target, while it sounds bold, is being taken seriously by people who have studied these markets for a long time. Now, I want to be completely transparent with you about something. Price targets are not guarantees. Nobody, and I mean nobody, can tell you with certainty where silver or gold will be at the end of 2026. Markets are complex, unpredictable systems, and even the best analysts get things wrong. What price targets tell you is the direction and magnitude of a move that someone believes is likely based on their analysis of supply, demand, macro conditions, and historical patterns. They're useful as a framework for thinking, not as a promise. Please keep that in mind as we continue. With that said, let's think about what the $80 silver forecast actually implies for the current moment. If silver is trading significantly below that level right now, and if the fundamental case behind that forecast is still valid, then every dollar that silver is below $80 represents potential upside. A pullback in silver's price, like the one we're seeing today, could look, in retrospect, like it was actually a moment of opportunity, or it could be the beginning of a bigger correction. Honest analysis has to hold both of those possibilities simultaneously. Let's zoom out even further for a moment, because I think it's important to understand the macro backdrop that's making this entire conversation relevant. We're in 2026 now, and the economic landscape has been anything but boring. Inflation has been higher and stickier than many economists predicted a few years ago. Central banks have been navigating a very difficult balancing act, trying to cool inflation without triggering a recession, and they haven't fully succeeded at either goal in a clean way. The federal debt situation in the United States remains a legitimate concern for long-term investors, and globally, there's a trend, not a rumor, an actual documented trend, of countries diversifying their reserves away from an exclusive dependence on the U.S. dollar. All of those macro factors create a backdrop where gold and silver tend to be viewed favorably as long-term stores of value. They're not perfectly correlated with any one of those factors, but collectively, that environment has been supportive of precious metals prices. The recent run in gold to levels that would have seemed remarkable just a few years ago is a direct reflection of how seriously sophisticated investors are taking these macro risks. Here's something I want you to think about that doesn't get discussed enough. There's a psychological element to investing in commodities like gold and silver that trips a lot of people up. When prices are rising quickly and everyone is excited, it feels easy to participate. The news is positive, your friends are talking about it, and getting in feels almost obvious. But here's the irony. When prices are rising rapidly and sentiment is euphoric, that's often when risk is actually highest. Conversely, when prices pull back, sentiment gets negative, headlines turn scary, and it suddenly feels like maybe this isn't such a good idea. That's often when risk is actually lower for a long-term investor. This isn't a universal rule, and I'm not saying every dip should be bought. Some dips are the beginning of much bigger downturns. But the pattern of human psychology in markets buying high because it feels safe and selling low because it feels scary, is one of the most well-documented and consistently damaging behaviors that everyday investors engage in. Being aware of this pattern doesn't make you immune to it, but it gives you a chance to pause and ask whether your reaction to a price move is driven by clear thinking or by emotion. Now, I've been talking for a while, and I want to make sure I'm actually giving you something useful rather than just a history lesson. So let me give you a framework, a way of thinking about this situation that you can apply regardless of whether you're already invested in precious metals or you're someone who's just starting to think about them. The first thing to ask is, what is your time horizon? If you're thinking about this as a trade, meaning you want to buy something today and sell it in a few weeks, gold and silver are genuinely unpredictable over short time frames, and trying to time those short-term moves is difficult even for professional traders. But if you're thinking about this as a long-term position, something you're comfortable holding for 1, 2, 3, or more years, the framework changes significantly. Short-term volatility becomes less important, and what matters more is whether the fundamental case is intact. The second thing to ask is, what does this position mean for your overall portfolio? Precious metals are generally considered a hedge, a form of insurance against certain macro risks. Insurance works best when it's sized appropriately. Nobody buys so much car insurance that it breaks their budget, and the same logic applies here. A position in gold or silver that represents a reasonable percentage of a diversified portfolio looks very different from going all in because you're convinced something big is about to happen. The third thing to ask, and this is the most personal question, is what you actually understand about what you're investing in. If you understand why gold has been rising, what the drivers of silver demand are, and what conditions would make either metal less attractive as an investment, you're in a much better position to make decisions. And, importantly, to stay calm when volatility hits. If you're buying because it feels exciting or because someone told you it was going to the moon, that's a much more fragile foundation. Let me take a moment here to check in with you. If you're finding this breakdown helpful, if this kind of calm, analytical look at what's happening in markets is the kind of content you want more of, please take a second to hit that like button and subscribe to the channel. It really does help this content reach more people who are looking for clear, honest analysis rather than hype. I genuinely appreciate every one of you who watches and engages, and it keeps me motivated to keep putting out this kind of work. Okay, back to the story. Let's talk about what could happen from here, because thinking through different scenarios is one of the most useful things you can do as an investor. There are really three broad paths forward for gold and silver over the next several months. The first scenario is a continued consolidation or moderate pullback. In this scenario, gold and silver stay under some pressure for a while, maybe a few weeks, maybe a couple of months, as the short-term factors that are currently weighing on prices remain in play. This could look uncomfortable in the short term, but if the longer-term fundamentals are intact, it might ultimately just delay rather than derail the larger trend. The second scenario is a resumption of the uptrend relatively quickly. In this case, today's dip turns out to be relatively brief, and buyers step back in, recognizing the value at lower levels. Gold reclaims higher ground, and silver starts to catch up, moving toward those higher targets that analysts have been talking about. This is the buy the dip scenario that a lot of bullish investors are hoping for. The third scenario, and this is the one that's least popular to talk about but important to acknowledge, is that something changes in the macro environment that is more fundamentally negative for precious metals. Maybe inflation comes down faster than expected. Maybe the dollar strengthens significantly. Maybe global risk appetite surges in a way that sends money flooding into equities and away from safe haven assets. In any of those cases, the recent trend in gold and silver could face more sustained pressure, and price targets that seemed reasonable would need to be revisited. Responsible analysis has to include that third scenario, even if it's not the one most analysts currently consider the base case. Markets have surprised everyone before, and they'll do it again. Now, one thing I find genuinely fascinating about this moment, and this is something I think about a lot, is the divergence between what's happening day to day in the market and what the longer-term indicators are suggesting. Day to day, we have gold at 4,870, a price that would have been considered extraordinary not long ago, but which now, after such a strong run, gets framed as falling. Silver is pulling back. The headlines say sell-off, and yet the structural analysis, supply dynamics, industrial demand, macro backdrop, central bank behavior, still paints a picture that many serious analysts find quite constructive for precious metals over a longer horizon. That gap between short-term noise and long-term signal is one of the defining challenges of investing. The market is simultaneously the most short-sighted and the most forward-looking mechanism that exists. Short-term traders react to today's dollar move, today's Fed comment, today's economic data print. Long-term investors try to look through all of that and ask what the world looks like in 12, 24, 36 months. Both perspectives are valid in their own context, but they can lead to very different decisions about the same asset on the same day. Let me give you an analogy that I think captures this well. Imagine you own a piece of real estate in a city that's been growing steadily for years. One month, the housing market in your area cools slightly. Maybe there are fewer buyers, prices tick down a bit, and a few neighbors who bought recently are underwater on their mortgages. If you were a short-term trader in that market, you might be alarmed. But if you're a long-term property owner who bought in because of the fundamentals of the city, job growth, population growth, limited land supply, you might look at that monthly dip very differently. The question isn't, is the price down this month? But has the reason I bought this property changed? That same logic applies to gold and silver today. There's also something worth saying about the relationship between gold and silver specifically, because I think it adds important context to why the silver price target is getting so much attention. Historically, silver tends to underperform gold during the early stages of a precious metals bull run and then outperform during the later, more explosive stages. The thinking is that gold leads, silver follows, but when silver moves, it tends to move hard. The gold-to-silver ratio, which right now is quite elevated, has historically compressed during the strongest phases of precious metals rallies. If that pattern holds, it suggests silver has significant catching up to do relative to gold, which is one of the reasons the $80 target doesn't seem as extreme to many analysts as it might sound on the surface. Now, I do want to be careful here not to oversimplify this. Historical patterns are useful as context, but they don't repeat with mechanical precision. Every cycle is a little different. The specific supply-demand dynamics, the macro backdrop, the behavior of institutional investors, all of these things add complexity that makes direct comparisons to past cycles imperfect. Use history as a guide, not a script. Let me also address something that comes up a lot when people talk about gold and silver, the question of how to actually participate in these markets. And I want to be very clear. I'm not here to recommend specific products or tell you what to buy. What I can do is give you a sense of the landscape. There are physical metals, actual coins and bars that you hold. There are ETFs that track the price of gold and silver. There are mining stocks, which can provide leverage to metal prices, but come with their own set of risks related to individual company performance. And there are futures and options, which are more complex instruments generally suited to more experienced traders. Each of these vehicles has different risk profiles, different tax implications, and different practical considerations. Understanding those differences is important before you put any money to work. The physical market, by the way, has its own interesting dynamic right now. Premiums on physical silver, the amount you pay above the spot price when buying coins or bars, have been a topic of discussion in the precious metals community, because they can widen during periods of high demand. That's something worth being aware of if you're thinking about that route. As we get toward the end of today's video, I want to pull everything together and leave you with a clear mental picture of where things stand. Gold is at $4,570 today, lower than its recent highs, but still at a historically significant level that reflects the genuine macro concerns driving demand for safe haven assets. Silver is also pulling back, but faces a set of structural tailwinds: industrial demand, tight supply, and the potential for the gold-to-silver ratio to normalize that have led serious analysts to forecast prices above $80 by year-end. That's a significant potential move from current levels. The pullback we're seeing today doesn't automatically make this a buy, but it also doesn't automatically make it a sell. What it does is raise a question that every investor in this space needs to answer for themselves. Has the fundamental case changed, or is this a temporary pause in a larger trend? Based on what we can observe right now, the balance of evidence suggests the fundamental drivers of the precious metal story are still intact, but markets are always uncertain, and anyone who tells you otherwise is selling you something. The right approach, and this is something I genuinely believe after years of following these markets, is to think clearly, act deliberately, diversify appropriately, and never invest more than you can afford to be wrong about. That sounds simple, but it's surprisingly hard to actually execute when prices are moving and emotions are running. The investors who do best over time are usually not the ones who made the cleverest short-term trades. They're the ones who had a clear thesis, sized their positions responsibly, and had the patience to let the longer-term story play out without panicking at every dip. Today's dip in gold and silver might look very different 6 months from now. It might look like a warning that people should have heeded, or it might look like exactly the moment that patient, informed investors were waiting for. Nobody knows for certain which of those it will be. What you can control is how you think about it, how much information you bring to your decisions, and whether you're acting from a clear plan or from a place of reaction. That's what this channel is here to help you do, not to give you the answers, because in investing, there rarely are clean answers, but to help you ask better questions and think more clearly about what's happening and why it matters for your financial life. Thank you so much for spending time with me today. If you got value from this video, please give it a like. It genuinely helps more people find this content, and that's the whole point. If you have questions or thoughts about gold, silver, or anything we covered today, drop them in the comments below. I read them, I appreciate them, and they help me understand what you actually want to learn more about. And if you're not subscribed yet, now is a great time to hit that button. We're putting out regular market breakdowns, and I don't want you to miss what's coming next.